Now, with that being said, that's one motive, is that the people that are propping this up are incrementally getting out. The second motive is to utilize this as a means of controlling Trump. I honestly believe that the financial forces, which, remember, they have a vested interest in the Democratic Party because it was the Democratic Party that not only bailed them out, but also gave them money in the Stimulus Package 2 bill. That's why I keep telling everybody, look at the Stimulus Package 2 bill, which was the first thing Obama and the Democratic-dominated Congress in 2009 voted in. It was the first thing they voted in. It was the first thing they made into law. Stimulus Package 2, look it up. And look at all the billions that went to everybody that donated to the campaign contribution account to the Democrats and to Obama himself. The biggest transfer of wealth in American history. So, with that being said, you have Wall Street having a vested interest in possibly making sure that the Democrats or an establishment Republican takes power. And to be honest with you, what Trump has proposed is against the interest of a lot of entities within Wall Street, especially the banking industry. So they're utilizing the prop up of this particular market as a carrot on a stick. And, to be honest with you, I don't think it's working with Trump at this point in time. But at the same time, that's not the only thing that they have in their pocket. It's not just the propping up of this market. I was talking earlier today with some folks about the real estate market, which has also been propped up. We need to take a look back at what really caused the 2008-2009 real estate crisis. Now, folks, people try to say that deregulation was the cause of the 2008-2009 crisis. I beg to differ completely. Now, I'm going to take a small portion of time to explain one more again to folks that don't understand what happened in 2009 crash on what exactly happened. Now, first and foremost, there was a contraction in the market. All right? There was a contraction in the market in which we saw not just necessarily a drop in the stock market, but in the jobs market. I mean, there was massive layoffs in 2008, and it wasn't just in blue-collar work. White-collar jobs were massively laid off, and as you know, I'm sure now, many of these folks that are, making these high-end white-collar jobs, they're spending next week's cash this week. I mean, so they're dependent on that income to suffice all the loans outstanding. That includes the house note, that includes the car note, that includes everything. Now, what happened is that at first, the first sign in which we saw trouble, and I saw it in 2008, you can look back in the archive, I saw it. While everybody was worried about, I don't know what people were worried about. I was hollering about the economy, and people were like, "Yo, you're stupid. What are you talking about? This is the greatest economy ever." The economy was such at a dwindling point prior to 2009 that, believe it or not, certain stores on Rodeo Drive and these big epicenters of high-end retail were exclusively accepting euros at the time, believe it or not. And moreover, not to mention, you had at the time certain artists that wanted to be just paid in euros at that time. Jay-Z at the time was vocal about him just being paid in euros. So, with that being said, there was a contraction, major contraction in the job market. So when people were laid off, that means they got no money to pay for next month's house note, next month's car note, and that ain't going to last very long. And as a result, people started foreclosing on their homes. Now, with that being said, before I get ahead of myself, okay, that was the precursor to what exactly was the domino effect of the goddamn crash of 2008-2009. Now, let's get to the housing market at that time. At that time, as much as the Democrats want to claim that it was deregulation that caused the crisis. What really caused it was this co-opting. All right, this co-opting of private and public enterprises or entities coming together in Fannie Mae and Freddie Mac. Now, for you folks that are unaware, Mr. Barney Frank and company on the Democrats made housing a major issue in the 90s, late 90s, early 2000s. I remember hearing Frank talking about, saying quotes like this, if you have a pulse, you should have a house. If you have a pulse, you should have a house. I mean, seriously, if you have a pulse, you should have a house. That's what he was literally kicking to the American people on a consistent basis via the mainstream media, okay?
Nur bis Sonntag bei Eurowings. 3 Millionen reduzierte Flugtickets zu den schönsten Zielen Europas. Schon ab 29,99 €. Schnell buchen auf eurowings.com.
Now, because of that, these co-opted private public entities that were created by the government so that folks that would have not otherwise got home loans, okay? Y'all remember, if you were alive and you were an adult at that particular time, literally you could have a $25,000 job and they'll approve you for a $150,000, $200,000 house. I'm not even joking around, okay? I'm not even kidding. Now, let me continue on because it's very complex. I know it's very confusing. People are tweeting at me right now. I thought it was Lehman Brothers. I thought it was this. No, calm down. You have to know the facts before anyone starts making assumptions. Now, because Fannie Mae and Freddie Mac were created so that private institutions, the big banks, Bank of America and all these big banks would give folks that would not have otherwise gotten home loans, giving them home loans, okay? And as a result, a lot of these people had to use, and when I mean these people, I'm talking about the financial institutions. They used a lot of financial instruments to be able to continue to sustain profitability amidst these risky loans. Because prior to Barney Frank and the Democrats pushing this housing kick, you had to drop 25% down. Before a financial institution would talk to your ass, you know what I mean? You had to put 25% of whatever the home was valued at, you had to put that down before the damn bank would even talk to you. And even then, they'd crawl up your ass with a microscope. All right? Now, with that being said, the Fannie Mae, Freddie Mac entities allowed the government to kind of quasi-force the private institutions into giving, quote, what do they call these people? Hard-working folk, which otherwise couldn't afford a home. Now, with that being said, the government was forcing private banks to give people homes that would have otherwise never have got them. So what's a bank to do? So what the financial institutions did, and this is really what caused the financial crisis, okay, regardless of what anybody says. Because banks were forced to give loans to folks that they wouldn't have otherwise given loans to, they had to figure out other means to make capital. Because they had anticipated, because they're financial people, anybody who's in finance and who's number crunching, who's a bean counter, can pretty much predict that the majority of these folks were probably not going to pay the house note in the long term, okay? The only reason they were doing it and giving loans to these folks because the government was forcing them to do it. Now, when these people were getting these loans and they were backed up by Fannie Mae and Freddie Mac, the financial institutions that were holding those house notes, those home loans, they were making bets amongst each other in a private market amongst the financial institutions. This private market was called the derivative security market. Now, derivative securities was a concept in which financial institutions would basically take bets amongst each other on a given home loan that was obviously rather questionable if it was backed up by Fannie Mae or Freddie Mac. Now, these institutions would take these questionable loans that many which knew that the probability of them foreclosing was rather high. They would take these housing notes and make derivative security bets on those notes. And one side would bet that that note would fulfill its note or fulfill the obligation of payment for a certain given amount of time, or to the fulfillment of the actual housing note. The other side bet that it was not going to happen, that we're going to be foreclosed on, and the bank was going to be left holding the note. Now, this bet obviously was something that was a supplemental income attempt by the banks because they were forced to give these loans out to people that wouldn't have otherwise gotten them because of the government's insistence, the government's pressure, Fannie Mae, Freddie Mac, the whole works. Now, these institutions and these derivative securities, they did this on such a massive scale that there was a lot of money exchanging hands on both the winning and the losing sides of these derivative securities, that AIG Insurance Company, one of the biggest insurance companies in the world, decided, hey, we can get some free premiums, or not free premiums, but we can get some premiums insuring these derivative security bets, meaning that if you're one side or the other and you're betting on a derivative security, you can buy insurance with AIG to get your money back just in case you lose the bet in a derivative security. Now, that's a very complicated scheme of things, but that's exactly how it happened, okay? Now, with that being said, this derivative security market was making gang loads of money. AIG was making gang loads of money on premiums because the market was booming. Once we had that employment contraction that I talked about prior to me describing the 2008, prior to me describing the derivative security market, when the employment market started contracting and people started getting laid off, foreclosures happen at a very rapid pace at a very fast amount of time. And as a result, when people lost their jobs, their homes were foreclosed on, their cars were taken away, and people that were in neighborhoods that were paying on house notes were seeing their neighbors being foreclosed on, and because these homes were being foreclosed on at such a rapid pace, it was bringing down the cost of real estate right before everybody's eyes. It was the first time anyone in housing market history had ever seen a massive decline in the real estate market because of the economic contraction. And remember, the whole reason why the real estate market was so hot was because the government forced private institutions to give loans to folks that wouldn't have otherwise got them, all right, with Fannie Mae, Freddie Mac.